And of course, let's take a look at Nigeria's fixed income market, which has rallied over the last few weeks. And this week it's been much less volatile. Let's cross to UBA to get a perspective from Egie Akpata. He's head of debt capital markets at UBA. Egie, it's great to have you on the show. And maybe we should first start by assessing liquidity in the money market. What I'm hearing is that we are having OMO auctions every day this week. Can you just tell us a bit about what's going on?
Yes, good afternoon, Wole. Thanks for having me on the show. I think it's a situation where the central bank is trying to mop up all that excess demand that came into that's been in the treasury bill market.
Right.
Particularly when you look at the like Wednesday auction, you see significantly more demand than is on offer for sale. So I guess the central bank is just trying to take out that extra liquidity as a means of controlling inflation and other metrics in the system.
Can you give us a sense of what yields are like for those OMO auctions, or maybe in the T-bill market?
Well, if you look at today's OMO auction, I mean, today's OMO auction was about 14.5%.
Right.
For maturities going into mid-November. That's significantly higher yield than what happened on Wednesday, when the auction was well under 14% for all maturities up to 364 days. So clearly, there's been a move up in rates in the T-bill market, at least between Wednesday and now.
Right, so the shorter end of the curve is, we're seeing yields move up there. But on the longer end, we're seeing over the last week for bonds, much less volatility. The previous 2 to 3 weeks, we saw quite heavy buying from international investors. But we've seen yields only move moderately this week. Your thoughts on why that is?
Well, I think, I mean, in terms of the bond movements are always a lot less volatile than the short-term T-bill move, the shorter end of the curve. The longer end is a lot less volatile. And obviously, the people who are buying into the long end have a lot more, have a slightly longer horizon, particularly in terms of when they think prices will peak. And they probably are expecting those prices to peak after October 1st, when the Nigerian bonds go into the JP Morgan index. Right.
Okay, so let's just run through the yield curve a little bit. I'm seeing on the longer end, yields move from about 12.5 to about 11.7 thereabout for maturities closer to 17 to 20 years. And of course, on the shorter end, we're seeing yields closer to 13.8% at the end of this week. So very little change compared to where we started the week. How do you see things playing out over the next few weeks? Your thoughts on where we may see the bigger moves? Because clearly this week we saw more moves to the upside in the longer end of the curve.
Well, I mean, in terms of the bond yields, again, as I said, most of the activity has been, the prices have been driven by the foreign interest coming into the market, and that interest seems to be somewhat there. But given the October 1st cutoff point, or at least inflection point, we shouldn't expect to see yields go much higher than they are now. Right. The shorter end obviously has competition from money market, because again, when you look at the T-bill rates, they at some point are competing with the bank deposits. Yeah. And some of those bank deposit rates have moved up very substantially to as high as 17%. Right. And of course, you have to bear in mind the tax differential between a bank deposit and a T-bill. There's withholding tax on the interest from a bank. There's no tax on the T-bill, and there's no withholding. Yeah. So you have to adjust for those differences. Okay. But there is competition on the short end, and so some of those T-bill rates will have to compete with bank deposit rates.
Clearly, we've seen yields move down quite a bit over the last few weeks. Are we seeing any appetite from subnational issuers yet? And what are you hearing? I imagine that there might be some deals going on. What levels do you think we might see deals at for subnational issuers?
Well, I think the thing to bear in mind is just how long these deals take to put together. I mean, any subnational deal you see coming to the market now has been in the works for at least a year or more, some as long as 2 years. So. It's really a case where they had everything ready and have decided to move into the market now. Right. Again, historically, those premiums over federal government yields have been as high as well over 2% in the past 18 months, right. And they've gone even below federal government rates. So it's a function of demand and supply, particularly when they're all book building transactions where people bid for the instrument. So if you're a long-term investor and you're getting 13.8% from the federal government, how much more do you think a state should pay you for you to lock in for 5-7 years? And that bidding process is what's going to determine the rates.
So your thoughts on that? If, for instance, you said 13.8% for a 5-year, if a state wanted to issue now, do you think they will find the market for their bonds at 16%, or do you think they will have to move closer to 17%?
Well, it depends. I mean, there are a lot of variables at play. One, for instance, is whether it's PFA eligible. If PFAs can buy a bond, then you have more demand, and in theory, that premium should be narrower than if PFAs cannot buy a bond.
Right.
Of course, also is the issue of the offer size. The smaller the offer, the easier it is to fill up, and the more you can actually get a tighter spread over federal government bonds. If you have a very, very large offer, then you might have to give everybody significantly more interest to get them into the bond. So it's very hard to tell now. I mean, post the MPR hike in October, those premiums have been very volatile. They've only been really 2 real state bond transactions are closed.
Right.
And it's very hard to use that as a benchmark for where the rates will go.
Okay, well, you have just about, what, 3-4 months to go this year. Your thoughts, do you think we'll see a subnational issue before the end of the year, or do you think it's more likely to be next year?
No, I think you'll see at least 2, probably between 2 or 3. That will definitely close this year. Bear in mind that with the states, again, their accounts go stale, most of them December 31st.
Right.
So they will definitely issue before then.
Okay,
and those will be the ones that are...
I was just going to say, we've seen some rating activity with respect to the likes of River State, so perhaps maybe they will get things going. Unfortunately, again, we can't take it further than that. Thank you so much for joining us. Look forward to speaking to you again sometime soon. Egie Akpata, Head of Debt Capital Markets at UBA.